welcome back to the Fourth Revolution, where we discuss stocks for your portfolio of the future. Those stocks of the future have caught a bid since mid-May, and it looks like there is a bottom in for these rich multiple names like Tesla, SPLK, Twilio, all these revolutionary companies that are driving, the next generation of technology. And you can see this illustrated when we take a look at Cathie Wood's ARK Innovation ETF, ticker ARKK. And we had a huge multiple compression starting in mid-February down to roughly mid-May. And the whole ETF dropped off roughly 40% from its highs. And this is due to like I said, this interest rate increase from fear of inflation and fear that the Fed is going to move much quicker than they originally projected. And this is all reversing over the last month and last week. Even when Powell came out with his hawkish comments, we started buying up these high growth tech names again at their relative discounted rate. And it's because we discounted them so significantly off of fear of this interest rate increase and a taper tantrum, so to speak. Because the Fed, we've been anticipating a Fed tapering of their $120 billion monthly asset purchases for some time, and now that we've been expecting it, now that the Fed is finally talking about tapering their balance sheets, the investors are finally buying up this discounted sector. So let's take a look at the ETF and some other stocks to consider as high growth tech falls back into favor in the markets. This is Cathie Wood's ARK Innovation ETF on TradingView, ticker ARKK. And you can see this valuation compression that I was discussing earlier from our February highs all the way down to this pretty precipitous and I would say definitive short-term low on May 13th. And this was a roughly 40% drawback. But we've caught a nice bid since then. And I think this is because investors are finally realizing that these are discounted names. Even though they have high valuations, their earnings continue to grow. And as their stock drops, they become relatively more attractive. And this is what people are looking for in the market, looking for companies like ARK's holdings that are going to drive growth for the next decade or longer. And that's exactly what our holdings are positioned to do. We have Tesla. That's the largest position in this portfolio of holding this actively traded ETF with about 9.5% allocation. And you can see this pretty much follows what we saw with the ARK ETF downfall from our 900 level. This was a little bit more exaggerated than what we saw with the overall ARK ETF, but still illustrating the same point that we had a big drop off, and now we're finally catching a bid with Tesla going above its 50-day moving average for the first time since early May. Twilio, similar story. We've been trading sideways effectively since October, and now the stock is catching a bid. And a lot of this has to do with, like I said earlier, the interest rates actually coming to fruition as far as expectations. So Jerome Powell came out last week and he discussed the fact that they're gonna, they're talking about tapering. That's what he called the meeting, the talking about tapering meeting. And it's putting more definitive and quantifiable data in investors' hands, and the fear is no longer there. The fear of a taper tantrum, the taper tantrum was Bernanke back in 2014, shocking the market with interest rate hikes. This is not going to happen. Jerome Powell isn't going to do that, and he said as much in his meeting last week, or his post-meeting press conference last week. He said that he's going to be effectively telegraphing whatever decision he makes before he makes the decision, and the markets have already priced in a tapering. And you could see that with this, like I said, valuation compression. That was pricing in the tapering. So now that we have, quantifiable evidence that tapering is going to happen in the near future, and a little bit more hawkish tones from the Fed. The Fed's finally controlling this inflation narrative, and investors are getting more and more comfortable jumping into these high growth, high multiple names. And you can see the same thing with CrowdStrike, which hit a fresh all-time high yesterday. This is the next generation of cybersecurity. This company is AI powered and on the cloud, and they are just unmatched with their capabilities for cybersecurity. And obviously, cybersecurity is a concern these days with Colonial Pipeline, JBS, the meat processing company, significant economic hubs being attacked by digital pirates. And we're seeing companies like CrowdStrike coming in and taking care of business. And this is going to be one of the first things businesses start spinning on, cybersecurity, because this is, vulnerable businesses is not going to be a business for much longer if they stay that way. So next generation cybersecurity is something that's going to continue to drive. And I think CrowdStrike is the best in class cybersecurity company out there. And I would consider adding a position to it. Like this is a company like NVIDIA that just is going to continue to drive growth over the next decade. And it's a name that you want to be in. Splunk is a different story. Splunk had a number of different short-term hiccups. We had the valuation compression as well as some earnings disappointments. This company is transitioning into a cloud computing company away from the on-premise, and this is obviously having margin retraction in their earnings, and they're missing on earnings. That's the bottom line. But it's transitional. This company is transitioning into the real-time data management cloud business that we all want, and this is what they need to be doing. It's just kind of a rocky road until then, and we've caught a bid, like I said, since early June. And yesterday we just saw a $1 billion investment by Silver Lake, a private equity company with $75 billion under management. And I think there's still a lot of upside potential to this business over the next decade as a long-term play. So all four of these companies that I discussed are all long-term plays, and you should expect short-term volatility. But like I said, they are the future of our economy, and I think that they're worth putting a position on, even if it's a small one. It's important to remember to have a barbell portfolio strategy, meaning you have these high growth names in one quarter, and then you have these reliable profit drivers on the other side. So you need to have a diverse portfolio of stocks, because obviously the narrative could change on a dime. But like I said, momentum is driving back into these heavy growth tech names, and it might be time to consider jumping in at these discounted levels that persist. You don't know how long these discounts are gonna remain there. You don't know how long these stocks are gonna remain on sale. So it's not a bad idea to start a position, even if it is small, like I said. So don't forget to check out Zacks.com/promo for top stocks under $10 a share. So thanks for watching, guys, and look forward to seeing you guys next time.